The global economy is in constant flux, with new ideas and systems emerging to challenge the status quo. One such idea is the Petro dinar, a proposed currency that has the potential to reshape the global financial landscape. In essence, the Petro dinar is a currency that would be directly linked to the price of oil. This concept has gained traction in recent years, particularly among oil-producing nations seeking greater control over their resources and financial destinies. The idea behind the petrodinar is to create a currency that is less susceptible to the fluctuations and manipulations of traditional fiat currencies. The US dollar currently dominates global oil trade, earning it the moniker petrodollar. However, some nations are seeking alternatives to reduce their dependence on the US dollar and exert greater influence over the global oil market. The petrodinar represents a potential avenue for achieving these objectives. The appeal of a petrodinar lies in its potential to provide greater stability and autonomy to oil-producing nations. By tying their currency to a tangible asset like oil, these countries could potentially shield themselves from the volatility often associated with fiat currencies. Furthermore, a petrodinar could enhance their bargaining power in international trade and reduce their reliance on the US dollar for oil transactions. However, the implementation of a petrodinar is not without its challenges. Establishing a new currency and gaining widespread acceptance is a complex endeavor with significant economic and geopolitical implications. It remains to be seen whether the petrodinar will gain the necessary momentum to become a reality or remain a theoretical concept in the ever-evolving world of global finance. The success of any currency, including the proposed petrodinar, hinges on its credibility and stability. This is where foreign reserves and gold play a crucial role. Foreign reserves act as a safety net for a country's currency, providing the necessary backing to maintain its value and facilitate international transactions. These reserves typically comprise stable foreign currencies, gold, and other valuable assets. For the petrodinar to gain traction, it would need to be backed by substantial reserves. These reserves would instill confidence in the currency and demonstrate its ability to withstand economic shocks. Oil-producing nations considering the adoption of a petrodinar would need to accumulate significant foreign reserves, particularly in currencies that are widely accepted in international trade. Gold, with its historical significance as a store of value, could play a pivotal role in bolstering the credibility of the petrodinar. By backing the currency with gold reserves, countries could enhance its stability and attract investors seeking a safe haven asset. The inclusion of gold in the petrodinar system could also mitigate the risks associated with fluctuations in oil prices, providing a counterbalancing force to maintain its overall value. The strength of the petrodinar's foundation would depend on the size and composition of the underlying reserves. A well-managed and diversified reserve system comprising a balanced mix of foreign currencies and gold would be essential to ensure the currency's stability and foster confidence among its users. The careful management of these reserves would be paramount to the long-term success and viability of the petrodinar. As nations explore the concept of a petrodinar, it's worth examining Russia's experience with its gold-backed ruble. In response to Western sanctions following the Ukraine conflict, Russia took steps to strengthen its currency by linking it to gold. This move aimed to reduce the ruble's dependence on the US dollar and create a more stable and independent financial system. Russia's strategy involved allowing the central bank to buy gold from domestic banks at a fixed price, effectively pegging the ruble to the price of gold. This measure aimed to create a floor for the ruble's value and mitigate the impact of Western sanctions. While the move did help stabilize the ruble to some extent, its long-term effectiveness remains to be seen. The Russian case study offers valuable insights for the potential implementation of a petrodinar. It highlights the importance of having substantial reserves, in this case, gold, to back the currency and maintain its stability. However, it also underscores the challenges of operating outside the established global financial system, particularly when facing sanctions and geopolitical pressures. The success of a petro-dinar would depend not only on the backing of reserves, but also on factors such as international acceptance, market confidence, and the ability to withstand external pressures. The experience of Russia's gold-backed ruble serves as a valuable lesson in the complexities of navigating the global financial landscape and the need for careful planning and execution. One of the key considerations for a petro-dinar is the mechanism for determining its exchange rate. A fixed exchange rate system, where the value of the petro-dinar is pegged to a specific quantity of oil, offers potential advantages, but also presents inherent challenges. A fixed exchange rate could provide stability and predictability for oil transactions, making it easier for businesses to plan and execute trades. This stability could be particularly appealing to oil-producing nations seeking to mitigate the impact of price fluctuations on their economies. However, maintaining a fixed exchange rate in the face of fluctuating oil prices could prove difficult. Oil prices are influenced by a multitude of factors, including global supply and demand, geopolitical events, and speculation. These factors can cause significant price swings, making it challenging to maintain a fixed exchange rate that accurately reflects the market value of oil. If the fixed rate deviates significantly from the market price, it could lead to distortions, imbalances, and potential arbitrage opportunities. Managing these fluctuations would require robust economic policies and potentially significant interventions in the currency market. Governments would need to carefully assess the trade-offs between the stability offered by a fixed exchange rate and the flexibility required to respond to changing market dynamics. Finding the right balance would be crucial to the success and sustainability of a petro-dinar system.